Hey, welcome back to the channel. If you're watching this, you're probably standing at a pretty common financial crossroads. You need some money and you're trying to figure out, should I take out a personal loan or should I just put it on my credit card? And honestly, this question trips up a lot of people because on the surface, both options give you access to cash you don't have right now. But under the hood, they work very differently. And picking the wrong one can cost you hundreds, sometimes thousands of dollars. So today, we're breaking it all the way down. By the end of this video, you'll know exactly which one makes sense for your situation. Let's get into it. First, let's quickly define what we're actually talking about. A personal loan is a fixed amount of money you borrow from a bank, credit union, or online lender. You get the full amount up front, and then you pay it back in equal monthly installments over a set period, usually anywhere from 1 to 7 years. The interest rate is fixed, meaning it doesn't change. You know exactly what you owe every month from day one. A credit card, on the other hand, is a revolving line of credit. You have a spending limit and you can borrow up to that limit, pay it back, and borrow again. You only pay interest on whatever balance you're carrying. If you pay your balance in full every month, you pay zero interest. But if you carry a balance, that's where things get expensive fast. So, right away, you can see these two products are built differently. One is structured and predictable. The other is flexible, but potentially dangerous if you're not careful. Section 2. Interest rates. Let's talk about the biggest factor most people care about. Personal loans typically come with interest rates ranging from around 6% to 36% APR, depending on your credit score. If you have good to excellent credit, we're talking 700 and above, you can often lock in rates between 7 and 15%. That's genuinely competitive. Credit cards? The average APR right now is hovering around 21% to 24%. And if you have a store card or a subprime card, it can go even higher, sometimes 29 or 30%. So, if you're going to be carrying a balance for more than a couple of months, a personal loan is almost always going to save you money on interest. It's not even close. Now, credit cards do have one huge advantage here, the 0% intro APR period. A lot of cards offer 12 to 21 months of zero interest on new purchases or balance transfers. If you can realistically pay off what you owe within that window, a credit card could actually be the cheaper option. But if you miss that window and the rate jumps, you're looking at a painful interest bill. Section 3. Flexibility versus structure. Here's where it gets interesting, because the right choice often comes down to your personality and financial habits. Personal loans are rigid, but in a good way. You borrow a set amount, you get a set repayment schedule, and that's it. There's no temptation to borrow more. There's no revolving balance to manage. It forces discipline. For people who tend to overspend or who struggle with financial self-control, that structure is genuinely helpful. Credit cards are the opposite. They're incredibly flexible. You can use a little or a lot. You can pay it off anytime. You earn rewards, cash back, or points. And in an emergency, you can access money instantly without any application process. But that flexibility is also where people get into trouble. It's easy to put things on a credit card with the intention of paying it off, and then life happens, the balance rolls over, interest compounds, and suddenly that $2,000 purchase is costing you $2,600. So ask yourself, are you the type who pays off balances quickly, or do you tend to carry a balance month to month? Your honest answer to that question matters more than any rate comparison. Section 4. Credit score impact. Both options will affect your credit score, but in different ways. When you apply for either product, the lender does a hard inquiry on your credit, which causes a small, temporary dip. That's normal and expected. Here's the key difference. With a credit card, your credit utilization ratio matters a lot. That's the percentage of your available credit that you're using. If your card has a $5,000 limit and you put $4,500 on it, your utilization is 90%, and that will tank your credit score. Experts generally recommend keeping utilization below 30%. A personal loan, by contrast, doesn't factor into your utilization ratio the same way. It shows up as an installment loan on your credit report. Making on-time payments consistently can actually help build your score over time. So if you're in a credit-building phase of your financial journey, a personal loan with a solid payment history can be a smart move. Section 5. When to choose each one. All right, let's put this all together with real-world scenarios. Choose a personal loan when you have a large one-time expense, like a home renovation, a medical bill, a wedding, or consolidating high-interest debt. You want predictable monthly payments, you're going to need more than 12 to 18 months to pay it off, or you want to avoid the temptation of a revolving credit line. Choose a credit card when you have smaller ongoing expenses you can pay off quickly. You're in that 0% intro APR period and can realistically pay the full balance before it expires. You want to earn rewards or cash back on everyday spending, or you need immediate flexible access to funds without an application wait time. One specific scenario worth highlighting: debt consolidation. If you've got multiple credit cards with high balances and high interest rates, taking out a personal loan to pay them all off and then having just one fixed monthly payment at a lower rate is one of the smartest financial moves you can make. It simplifies your life and saves you real money. Section 6. The catch. Before you run off and apply for either one, a few things to watch out for. With personal loans, look out for origination fees. Some lenders charge 1% to 8% of the loan amount just to process the loan. That fee is often deducted from your funds before you even receive them, so factor that into your math. Also, check for prepayment penalties. Some lenders charge you for paying the loan off early. With credit cards, watch for annual fees, especially on rewards cards. And if you're doing a balance transfer, there's usually a fee of 3 to 5% of the transferred amount. Again, do the math before you assume it's saving you money. So, which one is better? The honest answer is, it depends. If you need a large sum, want a fixed payoff timeline, and plan to take longer than a year to pay it back, go with a personal loan. If you can pay it off fast, want flexibility, or taking advantage of a 0% promo period, a credit card might be your move. The worst thing you can do is choose based on which one is easier to get rather than which one actually fits your financial picture. If this video helped you think it through, drop a like. It genuinely helps the channel grow. Subscribe if you haven't already, because we break down personal finance topics just like this every week. And if you've got a question or a situation you want me to cover, leave it in the comments. I read them all. See you in the next one.